Hey everyone, welcome to my channel. My name is Matan Hazanov. There are a lot of entrepreneurs out there who are looking to raise money. It's understandable. You have an early stage business, you want to grow, you want to succeed, and you see these amazing headlines of companies that have raised tens of millions of dollars with almost nothing. And you think to yourself, hey, I want to build a business. I want to grow. I have an incredible concept. I have an incredible product, a great team. I'm tackling big issues, and I need to raise some money to make my vision a reality. But before you go out there and spend all the time, effort, money, and headache to go raise venture capital, you have to consider these 10 things. In order to set yourself up for success, do and consider these 10 things before you send out your first email asking for capital. And the first thing is you have to evaluate the suitability for venture capital. Venture capital is a very specific type of investment, and most businesses aren't suitable for them. I'll give you an example. Let's say you're building a great plumbing business, right? And you think, hey, if I can raise some money and hire more people, well, my business will grow. Great idea. But most plumbing businesses, while the market is huge, it's very fragmented. You likely won't be able to build $1 billion business in plumbing because you're just going to have too much competition. It's going to cost too much money and take too much time to go build a business in plumbing. So you won't succeed in raising venture capital because that's not the typical type of business venture capital investors pursue. The type of business, in short, this could be a whole other video, by the way, the type of business venture capitalists like to invest in are the kinds of businesses that can get to $100 million in revenue or more in 7 to 10 years. And that only happens in typically very large markets, and you can get that kind of revenue very quickly, relatively speaking, because you're solving a big problem and you have something innovative with some barriers to entry that allows you to solve that problem, get the customers, build those revenues, and then get that big exit down the road. Because with $100+ million in revenue, you can sell your business for $1 billion or more. So the first thing you have to do is determine your suitability. A lot of resources out there that you can check out to figure out exactly what that means, but that's the first thing you should do. The second thing you should do before you go out and raise venture capital is start networking. Now, when I said networking, I mean go to startup events, go meet people in the industry, go meet your colleagues, your peers, your competitors, whoever, but also go to venture capital focused events where go to pitch competitions, go hear what other people are saying, what they're doing. Go meet other VCs, but don't meet them to raise money. Just meet them because you want to understand what they do and how they do it. Go out there and network, because when it comes time to raise money, you want to have a long Rolodex of people you can ask for help. Not just to ask them for a check, but ask them for advice, ask them for an introduction. And this just doesn't mean VCs, it means your colleagues, other entrepreneurs who have successfully raised money. And you'd be surprised how many people are open to helping. People love helping other people, especially if you're determined and you have a genuine passion for what you do and you're solving a big problem. People will want to help you. So the second thing you should do, go out there and start networking. The third thing you should do before you ask for your first check, before you send out your first deck, is actually figure out how much capital you need to raise. Now, this sounds like already part of the process of raising money, and it is, but what's important about this is that you have to set yourself up for success. You have to know exactly what you need to get to the next milestone of your business. Because if you ask for too much, that's a red flag. And if you ask for too little, believe it or not, that's also a red flag. Because again, VCs are looking for something very, very specific. And you have to make sure, and this is also part of the suitability evaluation you have to do, is actually figure out, is the type of business you're building realistic enough? And that comes down to how much money you actually need to raise. A lot of thought needs to go into this. And if it's the first time you're doing it, I recommend you get an advisor, ask for some advice, maybe get a VC involved as a friend, not someone to invest, but ask them their honest opinion, what they think about your venture and how much money they think you will need to get this thing going. And at this point, it's good to get someone that's done this before, meaning someone who's built a startup before and understands what it requires to take it to the next stage. The fourth thing you need to do before you send out your first pitch deck and start raising capital is actually research the type of people you're going to raise money from. A mistake I see quite a lot in my practice as a venture capital investor is getting a lot of emails from people that shouldn't be sending me emails. We invest in one firm in B2B software startups, and I get pitch decks from people that have consumer product businesses. And while it's great to see these entrepreneurs and what they're building and even speak to them, it's not a fit. It's not that the business is bad or it's not a suitable venture investment, but it doesn't fit our mandate. We can't invest in it. So what you need to do is start researching venture funds that invest in your kind of business. And what that means, your kind of business, the stage, the industry, the type of business it is, whether it's consumer or software or bio or something else. And there are plenty of investors for all different types of businesses and geographies and stages. And just to make sure that you have a solid list of those that invest in your business and start learning more about them so that you know who to reach out to when you're ready to send out that first pitch deck. And there are plenty of resources. For example, in Canada, the Canadian Venture Capital Association will have a list of all the active VCs in the country. So that may be a first resource to go to, and there's equivalent in different states in the United States and of course in Europe. The fifth thing you need to do before you go out there and start raising venture capital is refining your pitch. And there are a couple of different elements to this. Refining your pitch means create an actual proper pitch deck. It goes a long way to have a well-designed, well-structured, and coherent pitch deck with high quality content. Trust me, the first thing people will see about your business is your pitch deck. A lot of VCs, that's one of the first things they're going to see. And this content is essentially a marketing document. You have to take it very seriously because it says a lot about you and your firm. If the information doesn't make sense, it's incoherent, or it's poorly designed, that's a reflection on you and your business. And very good VCs, people that are out there doing their job, they get thousands of these a year. You have to be able to stand out so that the right VCs will want to speak to you, will want to learn more about you, will want to take that first meeting and learn more about your business. So that's the pitch deck. But also refining your pitch means that the way you give it over is also refined, that you're giving it over in such a way that is eloquent, that is logical, that is passionate, that makes sense. And this means you have to become a good public speaker. You have to be good at giving presentations. And those that are weaker in this area, you have to spend a lot of time. Go to friends and family and go pitch in front of them. Time it. And the more you do this, the better you'll get. It'll become second nature eventually. But this is something you have to do. You have to become good at, pitching, right? If you're and you can't outsource this to somebody else. If you're the CEO of a startup, this is your job. And maybe you'll have a co-founder that's better at it, which is fine. You can give it to them. This is a must-have skill if you're going to build a successful startup and raise money from VCs. The sixth thing you need to do before you start raising venture capital, and this is tied to number 5, is actually developing a compelling narrative. And why this is different than number 5, refining your pitch, is that a compelling narrative is not just about the materials or the content or actually understanding what you're tackling, right? The problem, solution, and competition and market and all that, which are part of your pitch. But a compelling narrative is the delivery mechanism that connects someone emotionally to what you're trying to accomplish. And the most effective narratives that I've seen is one where it starts with a personal story. Why do you care about the problem you're solving? Now, it could be boring, it could be not something so inspirational, but you have to find some reason to hook someone emotionally about the business you're creating and the problem you're solving, right? So that is creating a compelling narrative. It's taking that content and putting it in such a way that's digestible, that can give it over in 30, 45 seconds, and somebody will right away grasp what you're trying to do. The seventh thing you have to do before you start raising venture capital is create a data room. Now, we've looked at companies to invest in, and we're very interested. We love the entrepreneur. The pitch was great. The narrative was great. Everything was great. But we asked them for information. We got to start doing our diligence, which every venture capitalist is going to do. And the data room either didn't exist or was an absolute mess. This is a serious problem. Before you send your first pitch deck, before you have your first pitch, have all your documents in a well-organized data room. Now, you can get advice from lawyers, from other VCs, from colleagues, from peers, from competitors, from whomever, and you can see what is included in a pitch deck. You can Google it and you'll find plenty of great resources on what's included in a data room. Now, of course, it's going to include all the corporate docs, it's going to include your competitive analysis, it's going to include all the resources you have about your market and your product and your team, your CVs, all that fun stuff. Now, some VCs are going to ask for information that's not going to be included, which is fine, but you have to have the base ready and available to be sent out to the people that have demonstrated interest in learning more and doing their due diligence. You can kill a whole process of raising money from VCs if you take too long to give them the information they need, because they're going to go to the next opportunity. And we've done that before, where we're really interested in the business, but we asked for a series of information that they should have available, and it took them weeks to give it to us. And we're just like, listen, we have to get on with our lives. We have to look at other deals. We can't wait for this company. So we just went on to the next deal. And by the time they got back to us, we were in deep diligence with some other business, and we have limited time and resources. We can't look at too many deals at once. And we said, listen, come back to us in maybe a few weeks when we're done with this other transaction, and maybe we can look again. Don't make this mistake. This is an unforced error. And this is not something too difficult to do. Plenty of people can help you. Again, you can always ask for advice, always look on the internet for great resources on how to do this. But make sure before you go out there and raise venture capital that you prepare a well-organized data room. The eighth thing you have to do before raising venture capital is get your valuation correct. Now, everybody believes that their idea is worth billions of dollars. That's great, or else you wouldn't be doing what you're doing. But if you go to the market and you ask for a valuation that's too high, that'll turn people off. If you ask for a valuation that's too low, believe it or not, that will also turn people off. This requires a lot of diligence. You have to think through what makes sense for your industry, for your type of business, for your team. If you're a second-time successful founder, you can ask for more. If you're in a smaller market, you have to ask for less. If you're in a crowded market, or if you're in something very innovative, maybe you can ask for more as well. It all depends. Now, there are certain standards depending on the industry, the geography that you're in terms of what kind of range you can expect. And there are a lot of great resources out there like PitchBook or Crunchbase or CB Insights. And of course, VCs can help you. This is where an advisor will become very, very helpful. Someone that's done this in the past, right? Someone that invests regularly and understands what VCs are looking for and how they think through the valuations. But one way to actually think about it is, how much money do you need to get to the next milestone? Again, know how much money you need to raise. Again, that's something you have to do. And once you know how much money you need to raise, then the second question is, how much are you willing to be diluted at this stage to get to the next milestone? And VCs don't want to dilute founders too much early on, because they want someone that's incentivized to build this thing to the bitter end if they're the right person to do so. So they're interested to get a certain amount of ownership, but not to get too much ownership. So sometimes if you're a CCH company, that could be 15, 20, 25% dilution, meaning you're giving that up to your investor. But it really depends. And this is an important thing to seek advice for. Either a lawyer would be good, or a venture capitalist that understands your industry. But this is something you have to do and get right before you even go out there and start raising capital. The ninth thing you have to do before you start raising venture capital is actually familiarize yourself with the process of raising money for venture capital. Videos like this are great. Of course, there's many other resources out there in internet land and YouTube and LinkedIn, Twitter, whatever you want to call it. But familiarizing yourself with the process so you know how long it takes, what steps you need to accomplish, what you need to prepare, and of course, setting expectations. Some people go out to market and they think that they can raise money within a few weeks. This is wrong. Now, it happens in certain rare cases where you can raise money very quickly. Like if you see the show Silicon Valley, gives a very expedited version of what happens in real life.
Give you $200,000, $600,000 for 10% of your company.
$10 million.
Doesn't really happen like that, but it shows you this kind of fantasized version of what raising money. We have people pitching for, competing for an investment in your business, and you can do it in an afternoon. That doesn't happen. Almost never does that happen in real life. What I suggest is you have to learn the process, because raising capital can take up to 6 months, and in an environment like this, it can take even longer. And it has multiple steps. A term sheet doesn't mean you raise money, for example. You have to know a term sheet just means most VCs have enough information that they're willing to put some numbers down, and they're willing to invest the time and the money to due diligence on your business. But a term sheet usually is just a start. Then becomes diligence, and then they have to get approval from whatever investment committees they have, or their LP group, or whatever it is. Every VC group is going to be different. And then they have to do their legal diligence, and legal diligence and closing can take, in and of itself, it can take months. So you have to prepare yourself for the process. No, especially if you're already operating, you have to give yourself enough budget and runway to manage that process. You don't want to raise money when you're desperate. You don't want to raise money when you're running out of cash. You need it by a certain date or else you're done. And if that date is within 6 months of when you start to raise, that's a problem. You got to give yourself more than 6 months just to make sure you can do it successfully and if you're not desperate. And the 10th and final thing you should be doing before you start raising venture capital is understanding deal terms. Now, this is one of the most important things you're going to do in your life. You're going to go out and raise money, and you're going to get a partner, potentially a VC, and you're going to bring them into your business. And it's very important you understand what they're offering you in the term sheet, and of course the final deal docs itself. So learn the type of things they're putting in the term sheet. For example, what is a liquidation preference? What is weighted average anti-dilution protection, right? What is a right of first refusal? What are preemptive rights? What is a pre-money or post-money valuation? These are very, very important things you have to know. What is a preferred share versus common stock versus, all these other fun things that VCs will put. What is a safe versus a convertible loan? You have to know these things, because when you're getting these offers, and hopefully you will, you're gonna have to know what are you gonna do about it. And of course you can get a lawyer, but it's also important that you're not just asking a lawyer to learn these basic terms, you can learn yourself. That's very expensive. So I recommend looking on the internet, of course, speaking to your advisor who should be a VC, like we discussed before. But there's plenty of great books out there. Venture Deals by Brad Feld is a great primer on the different terms you'll find in a typical venture capital term sheet. So learn the terms, learn the knowledge, understand what your interests are, where you can push, where it's not appropriate to push. And of course, the industry changes constantly. What are the expectations and norms change constantly. So that's an important thing to ask your lawyer. What is considered normal? Is a VC being too aggressive, maybe not aggressive enough, which may show lack of experience? So these are important things maybe to discuss with your lawyer in terms of, hey, what kind of liquidation preference are we seeing in the market today? My investor gave me a participating liquidation preference. Is that considered normal or good versus non-participating? And if they gave you participating, I can tell you that's a very aggressive term and was more common maybe 15 years ago, but not today. That's something an advisor or a lawyer can tell you. Make sure you understand the deal terms before you go out and start raising venture capital. You'll save yourself a lot of legal fees and headache. So those are the 10 things you need to do before you start raising venture capital. And I guarantee you the process will be much smoother, much easier. You'll have a lot less headaches, and you'll set yourself up for success, because raising venture capital is hard. Most startups that go out there to the market and try to raise venture capital aren't successful because it's extremely hard. VCs are looking for the best of the best of the best. If you don't set yourself up for success before you start the process, you're not going to be successful doing it. So I wish you all the best of luck and happy hunting.